George Soros is perhaps best known in the financial world for breaking the Bank of England in 1992. But beyond his legendary macro trade, Soros has left a profound theoretical legacy, the theory of reflexivity. Reflexivity challenges the very foundation of modern economic and financial thinking, especially the notion that markets tend toward equilibrium and that prices fully reflect objective fundamentals. Instead, Soros proposes a world in which participant perceptions actively shape outcomes, a world where feedback loops between belief and behavior destabilize neat models. In this video, we explore the essence of Soros's theory of reflexivity, its philosophical underpinnings, its implications for how financial markets behave, and its significance for investment strategy. We'll trace how reflexivity has operated in historical market crises and asset bubbles, consider how it confronts dominant economic paradigms, and analyze how investors can apply its insights. Ultimately, this essay argues that reflexivity offers a more faithful map of market reality than rational expectations or efficient markets ever could. Reflexivity is not just a financial theory, it is a philosophical stance. Influenced by Karl Popper's notion of fallibility, Soros begins with the insight that humans do not possess perfect knowledge. In financial markets, actors don't passively observe the world, they are part of it. Their actions, shaped by their perceptions, influence the very outcomes they attempt to predict. This dual role of observer and actor is the foundation of reflexivity. Soros describes two functions in market participants: the cognitive function, how we understand the world, and the manipulative function, how we act on the world. When these two functions interact in feedback loops, markets don't gravitate toward a true value, they can spiral away from it. Reflexivity means that expectations and realities are mutually reinforcing, often in unpredictable ways. In traditional economics, the rational agent dominates. Homo Economicus is supposed to maximize utility with full information, leading to markets that naturally equilibrate. Prices in these models are reflections of intrinsic value. Reflexivity turns this on its head. Market participants are not omniscient. They are emotional, biased, and driven by narratives. This causes price trends to deviate persistently from fundamentals. Moreover, reflexivity introduces self-reinforcing feedback loops. For example, rising prices attract buyers, further raising prices, and self-correcting feedback loops. For example, a collapse following a speculative peak. These dynamics make markets inherently unstable and prone to boom-bust cycles. The efficient market hypothesis posits that prices reflect all available information, but reflexivity observes that it's precisely the act of believing something to be true that can make it true for a while. This temporary convergence of belief and reality makes mispricings more durable than EMH admits. We've got a couple of examples of reflexivity in action. Remember that global financial crisis thing? The housing bubble is a classic case of reflexivity. As house prices rose, lenders relaxed standards, enabling more buyers, which further inflated prices. Ratings agencies using flawed models justified risky lending. The perception that housing was safe created reality until it didn't. Once defaults began, the loop reversed violently. Tech stock valuations soared not on fundamentals, but on narrative momentum. As investors bought into the story of the new economy, capital flooded into unproven companies. Venture funding and IPOs amplified belief in continued growth. Reflexivity fueled a spiral where valuation followed sentiment, not cash flow. What does reflexivity mean for investors? It suggests that markets are less like clocks and more like weather systems, complex, nonlinear, and unstable. Identifying reflexive feedback loops can help investors position ahead of tipping points. Reflexivity emphasizes the importance of narratives. Markets move not only on data, but on what people believe about that data. Momentum investors, trend followers, and macro traders often rely implicitly on reflexive dynamics. Successful thematic investing often hinges on the spreading of belief, not just fundamental validation. Some critics argue that reflexivity is too vague to model. It offers post hoc explanations but lacks predictive power. Unlike EMH, reflexivity resists formalization. It's more lens than equation. Others point to behavioral finance as a more rigorous framework for irrational market behavior. But defenders of reflexivity note that markets themselves are not equations. They are adaptive systems with recursive feedback. Reflexivity aligns more closely with complexity theory and chaos models, which see markets as nonlinear and path-dependent. Beyond asset prices, reflexivity challenges how we think about macroeconomic policy. If expectations shape outcomes, then managing sentiment is as important as managing indicators. Central banks now acknowledge this implicitly through forward guidance. For portfolio managers, reflexivity is a call to humility. It warns against excessive faith in static models and urges dynamic thinking. It also underscores the value of second-order thinking, not just what will happen, but how will others react to what happens. To financial thought. It explains why markets often defy logic, why bubbles form and persist, and why perception can become reality. In a world awash in data but shaped by belief, reflexivity reminds us that human psychology is not noise, it is signal. For investors who seek not just to model the market but to understand it, reflexivity is not an optional perspective. It is essential.